We're here today with Bill Longbrake, Executive in Residence at the Center for Financial Policy at the Smith School of the University of Maryland. Bill writes a monthly letter called the Longbrake Letter, which touches upon various macroeconomic and financial policy issues. Today, Bill is talking to us about the ongoing European debt crisis. Bill, thanks so much for joining us here today.
Well, it's good to be here today, and the reason for this topic today is that there are breaking developments. They're important ones, and they are developments that actually probably pose the greatest risk for the U.S. economy in the year to come.
Okay, then we will definitely get into that a little bit later on. But to start out with, you mentioned some new developments, and we have certainly seen some. Just during last week's EU summit, a fiscal compact was endorsed by 26 out of the 27 member nations to implement new fiscal policy measures. Can you please elaborate on some of the details of the new fiscal rules and also the stabilization mechanisms?
Well, this was the meeting of the European Council, which is the heads of state or government of all the 27 European Union members. And the focus of attention was on the recent sovereign debt crisis in Europe. And the fiscal compact that came out of that meeting did have two parts, as you mentioned. The first part has to do with stabilization with fiscal rules, and the second part was stabilization mechanisms to deal with countries that are actually in the eye of the storm on the sovereign debt crisis, countries like Italy, Greece, and so forth. So let's talk first about the fiscal rule. Fiscal rule actually builds off of the Maastricht Treaty, which was what formed the European Union in 1991, and in that treaty there were two provisions that had to do with management of sovereign country budgets. One was the 3% annual deficit limitation, and the other was 60% public debt to GDP ratio. Those are both in the original treaty. What was absent in the original treaty was any kind of enforcement mechanism. So what the fiscal compact does is actually now put in place on a prospective basis those mechanisms, the enforcement mechanisms. And let me summarize quickly kind of how it will work, because there are some details that I think are interesting and important. First of all, the objective is actually for each country to run a surplus every single year. And so the first condition is that if they have a deficit that exceeds minus 0.5% in any single year, actually things begin to happen in terms of oversight and compliance. What then further is required by this compact is that the countries actually put in their constitution or equivalent binding legal framework that limitation of no greater than minus 0.5% annual budget, so that it has the force of law in those individual countries. Then the additional enforcement mechanism is that the European Court of Justice will actually then have the power to verify that the country is in compliance with their own budget rule. And countries then that are not in compliance per the European Court of Justice will be required to put a program in place to come back into compliance within some time frame, and those principles are yet to be worked out. During so that's around the annual budget deficit. Then there will be a time period, since many of the countries are not even close to that. There will be a time period for convergence, what they call convergence, so that you don't have this instantaneously kind of the shock treatment happening instantaneously. There will be some time period, and that time period hasn't yet been defined. That's to be worked out yet. Then there's a second part of that, and it's called members in excessive deficit, and those are those that are over the 3% annual budget deficit. Actually, much more severe consequences will occur. If that occurs, they still have to submit a program for correction. And however, if the breach is continued, then the European Commission is empowered by this compact to impose sanctions.
What types of sanctions?
Well, it would be sanctions that would, well, I'm not quite sure exactly what kind of sanctions, Michelle. That wasn't defined specifically in the compact, so I think that's probably yet to be determined by the by the Commission. And they did put a little piece in there, thanks to Nicolas Sarkozy, who's president of France, that if there's a qualified majority of European Union members who say, hey, those sanctions, that breach is, we shouldn't impose the sanctions, that by that qualified majority vote, a country can be excused from compliance, all right? Now, so that's the fiscal rule, and it also applies to the 60% over time. And we'll talk in a moment here about a country such as Italy, which has 120% public debt to GDP ratio. To get to 60%, that's not going to be an easy thing to accomplish.
Right.
On the stabilization measures, which was the second part of the compact, already in existence is the European Financial Stability Facility. That will continue, and in fact, all that was done in the compact was encourage rapid implementation of the leveraging provision that was actually determined back in October. But the main thing that's in there is to accelerate the implementation of the European Stability Mechanism. And the European Stability Mechanism is intended to be permanent, whereas the EFSS was actually a temporary kind of bridging mechanism. And the European Stability Mechanism must be approved by individual parliaments to become effective, and that's why it was going to take longer to put into place. But now the time frame is accelerated to July of next year, and the amount of its resources are going to be set at 500 billion euros. One other thing they did, because there was so much negative fallout from the Greek situation where private investors were encouraged to voluntarily accept losses, in the compact, it states very explicitly that in the new European stabilization mechanism, that private investors will not be expected to bear the burden of any losses. So this is intended to give an assurance to markets that come what may, the burden of loss will be borne by governments, not by private investors.
Right.
Then the final thing that was done was to have all of the members of the Eurozone, so that's 17 countries, agree to contribute 200 billion euros to the International Monetary Fund. And there was another statement in the pact that said we encourage other members of the International Monetary Fund, and that would be members like China and the United States and countries across the world, to contribute as well.
Now, is that likely?
I think it's very unlikely, because President Obama, for example, already has commented, and he said it in very diplomatic language, but I'll translate it into kind of practical terms, is why should the U.S. be on the hook for Europe's problems? All right. But the reason for increasing the IMF is simply to have more money available to help bail out countries that are having difficulties, like Italy, for example. All right. So that's essentially the key features of the fiscal stability or fiscal compact.
Great. Now let's go back to the requirement of the public debt to GDP ratio of no more than 60%. As you mentioned, Italy currently has a ratio of 120%. It seems like it's going to be pretty difficult for countries like Italy to achieve this requirement in any point in the near future. Is there a deadline for the member nations to meet these requirements?
The deadline, there is no deadline yet defined, so there will be a convergence period yet to be determined. And in fact, there was a provision in the fiscal compact that says the European Commission will propose a calendar for convergence. So that remains to be seen yet, but let's go to the real issue. There is no possible way that Italy can get from 120% to 60. All right, and the reason I say that is that the solution here, and this is something we should talk about a little bit, the solution is to reduce budget deficits by cutting spending and raising taxes, and the presumption is that you will do it to such an extent that you will run what's called a primary surplus, which will enable you then to actually reduce over time the total amount of debt relative to GDP. There is a huge, huge flaw in that, because when you cut spending, you tend to depress economic activity.
And currently, their academic activity is pretty depressed.
Well, and we can talk about that in a moment about recession, but essentially, when government spending is reduced, it has a negative impact on GDP growth. And if you just think about the ratio for a moment, numerator is debt, denominator is GDP. If GDP goes down and debt goes down, maybe you don't change the ratio, or maybe it even goes up if the GDP goes down faster than the debt does. And the debt won't go down as fast if the economy is performing poorly, because tax revenues go down and so forth. So I'll just say flat out, there is no possible way that Italy can reduce its 120% debt to GDP ratio to 60% ever. You know, it's not a matter of how long, it's ever. And indeed, the risk is in the other direction, that could get larger.
Right. Now let's talk a little bit about that recession. You know, data is telling us that Europe is already in a recession. The increased austerity measures that come with this fiscal compact are probably going to just make that recession even worse because of the lack of economic growth. We've already seen some protest in Italy against these measures. What's going to be the social impact of this treaty if it's implemented as it's currently planned? Well, the social impact is likely to be quite negative, but it will take time for it to develop, because the recession is only now beginning. It's well advanced in countries like Ireland and even Portugal. The numbers show that deep recessions are already there. Unemployment, for example, in Ireland is somewhere north of 15%. It's about 17% in Greece. The youth unemployment is over 50% in Spain. So these problems in the periphery countries are already well advanced, and already there's been some social unrest. But what's happening here, and the fiscal compact is actually going to reinforce this, is that all the countries in Europe, not just the periphery ones, are going to make sure that they comply with the requirements of the fiscal compact and don't get into trouble with the enforcement mechanisms, are going to become more conservative. For example, France just recently, because its growth has slowed, it's not going to meet its original objective. It reduced its budget spending some more. And so that's the direction of things. And as that occurs, it will reinforce the negative trends that are already in place. Now, there's a second thing that's at work here, and that has to do with the fragility of the European banking system. That was not addressed in this fiscal compact, and it's a serious omission. The European banks are actually in a retrenchment mode. And the reason for that is back in October, again, as a way of trying to make sure that the banks would maintain in healthy condition, is the authority said you have to raise your capital by July of 2012. Well, how do you raise your capital? You go out and get investors to invest. Who wants to invest when there's negative prospects? So the other way you do it, which is what is actually happening, is you sell assets. You don't make loans, exactly, and that's exactly what's happening in Europe right now. But the problem with that is it actually goes in the same direction as cutting government spending. It just crashes the economy. It just depresses any economic growth.
Right, so you've got both of those things going on. Recession is probable. Even the European Central Bank, when they came out with their recent forecast for growth for next year, they revised their estimate down sharply, and they have a range at this point that's as low as -0.4% in 2012 to a maximum of 1%. That's optimistic. All right, Bank of America Merrill Lynch forecasting has a -0.6% forecast for next year, but they've said flat out they think it will probably be worse,
even worse
than that. And indeed, as the data comes in, and the data now on trade and industrial production and so forth from the various Eurozone countries is coming in below expectations, it's very likely that the recession will be worse, considerably worse than the European Central Bank is forecasting. The worse it is, the more consequences there will be on the debt side.
Absolutely.
Both for the banks and for the countries themselves.
Now let's talk a little bit about what I spoke about earlier. Now this pact was endorsed by 26 out of the 27 member nations. Now, as you know, the UK was the one member nation that it was not endorsed by. Prime Minister David Cameron actually did not endorse this. Is there likely to be any fallout from his decision? Is it likely to jeopardize London's financial center in any way?
Well, I don't think it will jeopardize London's financial center. In fact, David Cameron said that was one of the reasons why he exercised Britain's right to veto. And in the European Union, with the treaty, any single member can object, and then the treaty, then modifications of the treaty will not proceed. So to get around that, this fiscal compact is actually being done in a different way, what they call intergovernmental agreements, as opposed to an amendment of the treaty itself. But, you know, come back to Mr. Cameron. Mr. Cameron is a Eurosceptic, which is just simply translate that to mean that he is not so sure about this project to integrate Europe as making total sense. And then there's in the political evolution of events and so forth, there's nationalism on one side, which is the rights of individual countries to have, you know, sovereign rights to do what they think is best for their own people and constituencies, their financial institutions, versus this dream of European integration, very much like the United States, in the sense that you build an economic powerhouse and you have political clout and global international relations because of this mass. But that is sort of the tension here that's existing between individual countries and then this collectivism. The collectivism is very, very powerful. It's deeply embedded in the political elite of Europe. It was, at the council meeting, it was pretty obvious that it was sort of play or you're going to get ostracized.
Right,
and David Cameron is ostracized at this point.
Oh yes,
and so
very much so.
So will it have consequences? Possibly, because to the extent that he was kind of the person who didn't play ball, he was the odd man out, there will be repercussions in that sense. It's interesting, the early feedback from Britain, predictably, the Labour Party is criticizing it as, hey, you've reduced Britain's influence in European affairs and so forth. This is a bad thing. And they're putting it politically for all it's worth. Nick Clegg, who's the leader of the Liberal Democrats, and they're in coalition with the Conservatives, is definitely unhappy, but he's being careful not to undermine the coalition because nobody wants to have elections right away there. But what David Cameron said is that he was the only very strong argument he made for vetoing the fiscal compact was to protect the UK, specifically London, as a financial center. And why is that important? Well, in the way in which things are set up in the European Union, in Brussels is the location of the European Commission, which is the bureaucracy or governmental body for United Europe. And they have all kinds of regulations they issue and requirements and so forth. And what Cameron is basically saying when he says, I want to preserve the independence of the UK financial system, is I don't want to be under the thumb of Brussels, all right? And maybe there's some merit to that overall. So that's essentially where David Cameron is coming from.
Okay. Now let's talk a little bit about the three major ratings agencies. Now they didn't seem entirely satisfied with the outcome of the summit. Now, how likely is it that we're going to see further credit downgrades of the European nations? And in the line of that, the agencies, as you know, have been under scrutiny lately for being behind the curve on predicting risk problems and default. So given this, how much attention is actually being paid to these ratings anymore? Would it matter if they were downgraded further?
It would matter a great deal, all right, for two reasons. One is simply the perception, and just think back to last summer when S&P downgraded the U.S. Treasury rate, and that was followed by the next day a 6% drop
Absolutely.
in the Dow Jones and S&P stock averages. So yes, from a perceptual point of view, it will matter a great deal. And from an actual point of view, it will matter too, because most entities that invest have ratings criteria on what they can invest. It will affect discounts or on collateral haircuts, that sort of thing. So yes, it will matter. All right. But here's the real rub, and let's get to the first part of your question is, are they likely to do the downgrades? My response to that is absolutely yes. And the reason for that is that they've been very specific. All three of the rating agencies, Moody's, S&P, and Fitch, have said, look, this fiscal compact did basically nothing to deal with the short-run deterioration of the European economy. It did nothing to shore up the banking system fragility. And we see the course that Europe is on, we being the rating agencies, as recession, deepening, and worsening these problems. And if that indeed occurs, what they've said, this is fair notice, we will do the downgrades on the countries. France, President Sarkozy already sort of indirectly admitted that the downgrade of France probably is likely to occur. So I think you can count on that happening. And the question will be, all right, does it matter? Yes, it will matter. How much will it matter? Maybe is the more real question. And I think that will depend literally not so much on the ratings themselves as it will on the course of the economic recession that's unfolding.
Sure, absolutely. So we'll keep a close eye on that. And just to end with our questions today, just taking kind of a 10,000-foot view, what do you expect will happen to the Eurozone in the next year or so? Is it going to continue to exist in its current state? And as you mentioned earlier, there are going to be implications worldwide of the ongoing issues in Europe. Can you speak to specifically some of the implications on the U.S. perhaps?
Well, let's take, you've got multiple questions here. So let's talk about the Eurozone and whether it's around next year or in years to come in the form we know it now. I think a year's time, it's hard to say, but over a longer period of time, I think it's almost inevitable that the structure of the Eurozone will change. And it won't look like it does currently, and that could either be modestly different or dramatically different, and the events yet to happen will determine that outcome. But here's why I say that. For a union to work economically, what was missing to date was the fiscal discipline. The fiscal compact is attempting to put that into place, all right?
But is it too late at this point?
It really is too late because you've got two other problems that exist right now. One is the banking system is not in good condition, and there is not really a practical solution to do that. What happened in the U.S., for example, was through TARP to recapitalize the banks, all right? Europe doesn't have that type of program in place yet. Now, they may be forced into it, but it would be forced into it and more damage would be done before that. The other thing that you don't have is any way to deal, as we talked about a few moments ago, about the countries with high debt ratios. And simply to force them to try to get there over time is going to just crater those economies. And as you crater an economy, eventually you get social unrest and probably political change.
Absolutely.
All right. There are still some potential solutions to that. You could have the euro Eurozone as a whole agree to take on the Italian debt and the Spanish debt and the Irish debt, so it becomes a joint obligation of the entirety of the Union.
And that
The
would take some
Germans are
convincing.
absolutely opposed
Right.
to that at this point, but that could be a possible solution. But you still yet have another problem, and that is the competitiveness of one country with another. So and this comes back to the German economic policy. German economic policy has been focused intentionally on exports, and they run an annual trade surplus that is huge. Without going into the details of it, if you run a trade surplus, well, the money comes back to you and you have to redeploy it somehow, which is what the Germans have done, but they've redeployed it through making,
Right.
through their banking system, loans
Through the
to
loans.
sovereign countries. And
Which only
you
exacerbates.
cannot resolve the competitive differences between countries as long as Germany pursues this particular economic policy. And there's no interest in Germany of changing
They're not
course. I
stopping
don't
that
think they
anytime
even
soon.
understand it. So it's for this reason I say you cannot resolve the basic fundamental flaws in the Eurozone as matters now stand and as policy is being developed or is likely to develop. And that eventually will lead to a forced change in the membership of the Eurozone.
Okay. Now,
So
what about
stay-
the implications for the rest of the
Well,
world?
the implications for the rest of the world, I mentioned it earlier, is that the European banking system actually has huge financial interlinkages with banks throughout the world. It is a major lender in South America and Asia, and as it pulls back, it will inevitably have consequences on that. What we know from the experience in 2008, that financial affairs really matter in economies. You can crash trade very quickly if you have liquidity problems or uncertainty problems, and that you can already see spreads have widened, not just in Europe, but in the U.S. and other places. So those tightening of financial conditions will have negative consequences. And then through the mechanism of trade, as you get pullbacks on that, that will ripple through too.
Right.
So the only real question is what will be the order of magnitude of the consequences. And it's too soon to make
Maybe
a
it's yet
prediction.
to be
It might be
seen.
mild. It certainly won't be nothing. Nobody is isolated from the European situation,
Right.
and it could be very severe.
Sure. Okay. Well, as always, we will keep an eye on this and see if we have any other other developments coming forward.
All right.
Thanks so much for joining
Well,
me
and
here
happy
today.
holidays to you.
Happy holidays.